Welcome back, listeners, to the BizBlend podcast. I'm your host, Sana, and this is the space where business meets real world hustle. Now, today's episode dives deep into the art and strategy of structuring real estate deals, not just to turn a profit, but to create security and long term wealth. Our guest, Fuquan Bilal, he's a powerhouse in the real estate world. We share a bit about him with all of you listeners as the CEO of NNG Capital Fund. Fuquan has raised over $50 million, built high performance portfolios across North Jersey and the Southeast, and he's known for making creative real estate strategies both profitable and accessible. From humble beginnings to top tier investor and educator, Fuquan has built and helped countless people level up their financial game. So, if you have been curious and interested about deal structuring, risk mitigation, or you are interested to how to truly spot an untapped opportunity, you'll want to stay locked in, my friend. So, with that, Fuquan, welcome to the show, and I'm absolutely excited for this discussion.
So have me. I appreciate it. Glad to be here.
Wonderful, wonderful. Okay, Fuquan, before we talk about our topic, I believe in this age of digitalization and everything, people connect with real stories, struggles, and journey transformation. So, with that, I would love to hear maybe a glimpse or maybe, how exactly was your journey before you came to the world of real estate?
I've always been into sales since I can remember, anywhere between 8 and 10 years old. When I was younger, my mom used to take us to what we call here in the States a flea market, a bazaar, if you will.
Yeah.
And she used to buy goods from wholesale, Chinatown, and we would sell them retail at this little booth or table that she would rent on the weekends to make extra cash. So, growing up in a single parent household, my mom and she raised 5 kids on her own, and it was a financial struggle. So, me learning those sales tactics, getting people to say yes to buy the merchandise was fun and exciting for me. And it was something that I wanted to do when I got older. I wanted to be in sales. I didn't know what part I would wind up in. So through my journey in corporate, I did sales with telemarketing. I did sales with computer companies, and that really kind of gave me an understanding of sales and business. So I believe it was around 26 years ago, 99 to be exact, when a family member of mine was having a successful run into real estate, same age as me, but took that route instead of going to college and corporate, just straight out of high school, started real estate and it started to make actually more money than I was making. So I started to become a student and shadow our family member around. And lo and behold, I was having some success as well. And kind of jumped out the window and grew wings falling down. But it wasn't easy. It was really a challenge because no financial literacy, didn't know the money management skills. So the more money I made, the more money I would spend. Very materialistic, wanting all the things that I couldn't get. Went through that whole transition of maturity. And by the time I got all of that out of my system, we were hit with the global financial crisis in 2008. So I literally had like a 9 year run before the global financial crisis of 2008 hit. And that kind of set me back, took major losses. And then the impact was uh, divorce and all those other things that comes after you have a financial crisis. So good lessons learned. I wouldn't change anything from what I went through because it made me who I am today. And there's always challenges that you go through in any business, but that's pretty much a glimpse into the journey.
That's fine. I know it can be sometimes very um, uh, tough to summarize the countless moments of highs and lows, but thank you for sharing that, Fukan. And I was about to ask you, because as I mentioned, 26 years, and real estate, I was about to ask you about the 2008 financial crisis because That was a huge one. Probably um, during pandemic and COVID, it was such a kind of deja vu. Unfortunately, I mean, and fortunately, maybe I was not in the job market at that time. I was still having my graduation, but among my family friends, who those who were graduated, immediately before the crisis happened, I had kind of gotten a sense that how devastating it was personally, and at a larger level. So, of course, that's what made you who you are. And with that, you have structured hundreds of real estate deals. So, what's the first principle, Fuquan, you teach when it comes to maximizing both profitability and security? I mean, how can they go both hand in hand?
Well, everything comes to due diligence, whether you're doing due diligence on the sponsor or the deal, it all starts there. So, being able to have the knowledge to underwrite deals is a skill set that an investor must learn, especially in the asset class that they are choosing to invest in. So being able to do the proper due diligence on the person, track record review, and also being able to review the deal, it goes a long way. Being able to know how to underwrite the deal properly and do the proper due diligence.
Hmm. And are there any factors to check while you're doing the due diligence? Because many of our listeners, specifically who are associated with real estate, they would jump straight to ROI. Calculating the value and then the inflation rate and everything, and then how much ROI it will give me. But are there any other factors to consider while doing the due diligence?
Yeah, so it really depends on the asset that they're evaluating. Every asset comes with a different set of due diligence. I'll just use in general one of the verticals that we invest in, which is luxury spec homes.
Okay.
So we look at what new construction sell at, square footage size, bedroom, bathroom size, and then we look at the lot to determine if we're going to tear the house down and build that, or if we're going to add an addition, can we build that same product to try to capture that value? Is there other case studies that of properties that sold within a mile range that will give us that same value? So that's one of the things that we do. Also, the costs for materials, we verify the cost to build per square foot for certain products to make sure that that stays the same, because that's always something that a developer never have 100% grasp on the cost, because it's like a moving target, especially with the inflation now and price adjustments on materials and labor. So just really building in contingency on that, somewhere around 15%, 20% if you can, on your construction costs. And when you look at the value, the future value of what this is going to be worth, you want to take probably 80% of that, to look at, if I only got 80% of what my expectation value is, and I built in holding time, if it's going to take a year, if I built in a 6 months additional, so that's 18 months holding time, and I have 15 to 20% variance costs in my construction. If I can still make 15 to 20% on this deal with those risk adjustments, then it's a green light. It's still a good deal. If I can't, then it's not going to pan out. So really doing the due diligence on paper, then going to the site and making sure you ask the right questions. That's important. There's just some preliminary things. Value is really what someone is willing to pay, right? So you can always go off of the comparables, but once the house is built, is always comes down to what someone is willing to pay.
Hmm. And this 15 to 20%, you are mentioning. So, of course, with the holding time and everything, and huge, quick shifts coming in the market, constantly, how do you avoid decision fatigue or maybe chasing trends? Because that has been so rapidly evolving, within a month, within a week, trends are shifting, markets are shifting.
Yeah, I mean, it's really if you have your with that model that I just mentioned, the only thing that changes is the cost of materials, which you can do things to mitigate that. For example, you can give your vendors letters of commitment. If you're building, you know, 2 or 3 projects, for example, you can go to your lumber yard and say, hey, we're going to buy X amount of lumber from you. You pretty much guaranteed. Here's a letter of commitment as long as you give me same pricing. So
Mhm.
you can kind of pre-order materials without warehousing them
Right.
with some of your vendors just by giving them a letter of commitment. So those are some of the things that you can set up to, be successful with mitigating the cost of the materials. That's the only thing that would change. So if the market shift and the value change, remember you're underwriting this at 80% of the value you think it's going to be. So
Mm.
you already mitigated that risk. And you built in additional holding time also. So um, building it as if it was COVID, your underwriting model, and
Mhm.
it still works, then it's a really good deal because that's the worst case scenario with risk adjusted yield. So
Mhm.
um, it's all in the underwriting, like I mentioned in the beginning, is how you underwrite the deal. And you have to look for great deals, not good deals, especially in this market.
That's quite a practical outlook to this, quite a practical one. Something which I also personally believe in. Um, Not only in the deals, but in any scenario. What could be the worst case, and how this can be win-win for both the parties. Whether it's vendor or it's the buyer or the purchaser. Um, and now I can definitely get a hint that you always stress on creative strategies in your deals. So, to help people understand it more in a better way, can you give us an example of a creative structure that worked better than a traditional one? And maybe what was the secret sauce behind that? If you're okay to share with that.
For sure. For me, it's seller financing. If you can find a deal where the seller will become the bank or you can assume the debt on a property, that's an ultimate deal. So I give you an example. Last year, actually 1 year today, to be exact, the end of the month last year, we closed on 142 units in Macon, Georgia. And the market this time last year was terrible as far as acquisitions.
Mhm.
A lot of property owners were going through things. Interest rates still are high in that space for multifamily. That's the other vertical that we have is quality affordable housing in low income areas. I
Okay.
come from that, so it gives me the feeling of importance to go back to those areas and provide quality housing for low income, not just quality luxury spec homes here in New Jersey, but also in areas where people can benefit from quality affordable rentals. So we acquired 142 unit and we were able to assume that mortgage at 5.1%. And that was a fixed rate for 5 years and we've only owned it for a year. So it gives us time to execute on our strategy without expensive debt on the property. So, that was a great deal because the yield was there, the cash flow was there, and one of the strategies we used was assuming a mortgage. Now, on the luxury spec home side, one that was very successful for me was making the current owner become the bank. So some owners don't want the tax burden of selling a house and they don't have a mortgage on it or they have a low mortgage and it's this big gain and they have to, pay taxes on it. They would rather become the lender, take a little bit of money, become the lender, loan to an LLC, and they make, 7, 8% for, 18 months. And that's a benefit to me because the cost of capital is lower. I don't have to come up with that much money to be in the deal. The benefit to them is they can take a little bit of money, pay taxes on that, and become a lender. And when the loan get paid off, it's different. So it's not the same taxes that they were going to pay when they sold the property. So trying to create some sort of owner finance and let
Mhm.
the seller become the bank. And it's an education process because not all people understand how that works.
Yeah.
So they have to have a competent attorney to understand it, to be able to explain it to them, to explain the benefits to them, for that to be a successful transaction. But that's where we made the most of our wins is educating the sellers, getting them to hold the paper and to become to bank. Or if it's a larger deal, like the $10 million purchase we made last year,
Mhm.
getting them to work with us to assume the mortgage.
Wow, that is really sensible, really sensible. I think it's more towards empowering the seller as well. And once again, it can be such a win-win situation. Um, and you have raised $50 million, and that's a big deal. It's not a small feat. So, um, any top two trust building factors that helped you secure investor confidence again and again, especially with so much high and low especially in the real estate market?
Yeah, so to date, we've actually raised closer to $60 million.
Wow.
And the two factors that I would say is your track record and also being invested in the deal. So, investors want to see how much skin you have in the game, how much do you believe in it? And
Mm.
that is, you know, something that they look at when they're invested in a deal to make sure that there's some sort of alignment that the sponsor or the person who's raising capital have some skin in the game, and also that the sponsor have a track record of the asset class that they're raising capital for. We've seen that uh, be very successful with investors. I mean, there's several things that I can list. Communication is important. Investors like communication, whether it's good, bad, or ugly. They want you to be transparent, share the information right away.
Mhm.
Say it loud, say it proud. Even if it's something you think that they won't take well, they will appreciate you giving them, the news. And then, of course, what are you going to do to mitigate the risk? And then continuous updates. Every deal has challenges.
Mhm.
There's no perfect deals. I've been in this business for 26 years, and it's been a few deals that were easy, but majority of the deals that I've been through were learning lessons that I've learned,
Mhm.
uh, profitable. I've lost money in deals. There's a lot of people who say they never lost money. I've lost money personally in deals. Always make my investors whole, and that goes a long way. You know.
Mm. That is really mindful. That is really mindful. And since we are talking about, mistakes do happen, and as a leader, as a front runner, um, even if your mistakes, it's so much vital to acknowledge and accept, and also help others, you know make them educated about, not committing those mistakes. So with that, um, what are the biggest blind spots or uh, you know um, early warning signs that you see investors make when structuring deals, and how can they fix them before they cost real money?
Your question is more of what mistakes do I see investors make when
Right.
they're invested in deals? Okay. Again, back to the due diligence.
Okay.
I see a lot of investors get referred from a friend or friend of a family,
Mhm.
and they say, "Oh, since my friend is investing in it, it must be a good deal because they know what they're doing. They've always been successful." And then they don't do the due diligence. They just, you know, lend the money. And then when things go wrong, they don't accept the responsibility. So That's one of the biggest mistakes that I see investors make is trusting without verifying and not doing a due diligence and thinking that because someone else brought them into the deal and that person is a reputable person, that everything is okay. I've seen a lot of investors lose money like that, the herd mentality and not doing, their own push-ups, sort of, and not doing a proper due diligence. Everything comes back to that key word is doing the due diligence is important in every deal, whether it's on a deal or on a sponsor.
True.
Those are the mistakes that I see investors make.
No, I agree. I agree. And what what's in how does the future of real estate look like, Fukan? I mean, you are into the residential side, but do you think that there are opportunities when it comes to commercial as well? Especially now when we are completely out of that pandemic, you know, phase where it was more from your homes rather than co-working spaces or commercial spaces. Now, when things are gradually coming into the full flow of business as usual.
I think that you have to have diversity.
Okay.
That's how you are able to pivot within the marketplace, right? Because for example, buy, fix, and sell of houses, fix and flips, we call them here in the States, may be something that's prevalent now. And then something else may be prevalent, right? So the interest rate drives the bus. There's a lot that can be done when rates are low. There's more people in the business. Your next door neighbor is a house flipper or in real estate when interest rates are low. Uh, but you have to have a diverse strategy, and that can be with some of the things that I just mentioned earlier, right? Making the seller the bank. So, for example, multifamily is really a tough market now because a lot of things are in distress, and the banks are only it's expensive debt to buy something that doesn't have 90% occupancy. So, someone like me that will find a good deal that's not 90% occupancy, I'm going to try to negotiate with the seller to become the bank so I can get fixed debt at a low rate, cheaper than I would be able to get from a bridge lender.
Yeah.
Bridge lender is anywhere 10 to 12%. If I can get this homeowner who's owned this property in their family for 30 years, some cash or maybe 8% of their money or 7%, whatever I can negotiate for a year or two before I can get it going and stabilize it. Those are the type of deals that I'm going to try to execute on. So you have to have diversity in your acquisition, diversity in your strategy in order to navigate the narrows in this market. Because it's a tough market and it will eat you alive if you don't stay ahead of it and learn how to adapt and be open to pivot and change. And you have to have good team members also. Um, you can have the vision and you can be a great executor, but if you don't have the right team members that can adapt or have the proper mindset to be able to adapt with the market, then, you don't really go too far.
Mm. Those are some very fundamental, basic, yet often overlooked aspects. Uh, irrespective of whether it's a real estate business or anything, but from investors' point of view or a buyer or a seller point of view. Um, so, Fuquan, if our listeners they would like to connect with you, especially those who are interested in understanding the real estate business and how you can help them understand uh, deals in a better with a better point of view, how they can reach out to you.
So I love talking real estate. It's like an AA meeting for me. I can talk for hours about real estate, but if you want to learn more about our strategy and what we do and how we're navigating this current marketplace with investors capital, you can go to nngcapitalfund.com, set up a discovery call. I would like to learn more about your investment strategy. And I would like to also share with you what we're doing with our fund investments in the areas that we're impacting in the Southeast with affordable housing. and what we're doing here in New Jersey with the luxury spec home. So you can also reach me on social media at Fuquan Bilal on Facebook, Instagram, Twitter, LinkedIn. I would love to share my journey with you and learn more about you.
Wonderful. I'll make sure to have all the links and details in the show notes for our listeners to reach out to you easily, Fuquan. And thank you so much. This was some serious, knowledge on how to build wealth with clarity, confidence, due diligence, and creativity. So I'm going to take the keyword due diligence, and I hope all the listeners, uh, they have gotten some golden nuggets. And if today's conversation sparked ideas or even challenged your assumptions, listeners, that's the point. This blend is about real business, real risk, and real results. So, Fukan, thank you so much for your time. It was absolutely an insightful one.
Absolutely. Thank you for having me. I really appreciate it.
Listeners, thank you to every one of you for being a part of our journey. And as always, I keep on saying, keep blending the hustle with the strategy. You're not just building businesses, you are building legacy. So, with that, this is your host, Sana, signing off. Thank you.